All right, Q2 Lemonade earnings are coming up on August 5th, 8 a.m. Eastern. They will probably do the same format as last quarter where they release the earnings letter something like 45 minutes before the earnings call, the same morning of, and then people have a chance to kind of read it and then dive into the call. So in this video, I want to give my forecast, my thoughts on how the quarter might shape up, some detailed numbers, my overall thoughts on it, then also metrics I'll be watching for that are really obvious metrics maybe, but then some that are not so obvious that you really have to be carefully watching to understand and sort of show underlying performance of Lemonade. So let's dive into the video. First of all, I want to show you Google Trends for Lemonade car, pet, and renters. They're all spiking, all at all-time highs relative to themselves. Home, if you plug home in here, it's a bit more of a zigzag straight line as they sort of got into home and are being very, very much more careful with home now. But you can see a lot of interest in Lemonade, and that's because they're spending a lot more on growth spend than they were. So they're spending something like 40% more year over year for 2025 versus 2024. In 2024, they already spent a lot on growth spend versus 2023, which was significantly less. Looking at the guidance for the year, so you have IFP, the high end, $1.064 billion. Adjusted EBITDA loss of minus $41 million. For the whole year, they're talking like $1,208 million of IFP and $135 million loss, adjusted EBITDA loss. So that's roughly, we'll flip back and forth to this sheet here as I look at my model. That's roughly where their guidance is kind of set. If I flip up to the top here, and just to be kind of clear, it's not like my model is ever set entirely in stone. I mean, I'm of course trying to look more carefully at Q2 right now, but I have kind of rough projections out into the future, and then we iron out the details as you get into each quarter and how it sort of could shift more positively or negatively one way or the other. But what I'm trying to say is it's more important to me to understand with my model sort of the dials and variables you can kind of move one way or the other and the overall effect it would have versus merely trying to be like, I'm perfectly nailing this quarter's numbers. It's more important for me to spend the time and be like, okay, I understand how things will be affected and the sort of range of possible outcomes depending on how these variables will pan out. So I'm at, for IFP, in-force premium, Q2, $1.073 billion. This is versus a guidance of, top end 1064, and they have a history of beating their guidance. So I think there's a good chance they beat that. 28% year-over-year growth, continued acceleration in growth. And also just to make another point here, the way I've set up my model is I'm looking out into the future. Up to right now, I have it set up out to 2033. That Lemonade could do a 10x of their book of business from $1 billion to around $10 billion around the end of 2033. And you can see I've broken down that $10 billion. If I scroll way down my model here, these red boxes, into each different product that they currently have. And this is based, the sort of breakdown between each product is based on a slide they showed at Investor Day, where they showed sort of a potential path to the 10 billion mark and how that might sort of split between their products that they have. So what I'm doing is I'm kind of using this as an anchor point to say, hey, they're somewhere out here. Maybe it's earlier, maybe it's later, but around there, they're going to get to 10 billion of IFP, and the market's so huge, I believe them that they're going to be able to do that and way more, especially when you have superior products. And then I work backwards from that to say, well, what are the sort of growth rates to get through there? How much are they going to have to spend on marketing? What's that going to factor into their finances to get to that point? So, but for Q2, $10.073 billion of IFP. I still have reinsurance at 55%, so that's still fully in effect for Q2, and then that's going to slowly taper down to 20% as that announcement, whatever it was a month or so ago, where they announced they're dropping their reinsurance down to 20%. So I have that tapering off as the book of business shifts to that different sort of risk setup. but still at 55% for Q2. I have loss ratio of 63%. You might think, wow, 63%, how did they possibly get such a low loss ratio? Well, there's a few ways to look at it. If you think about, first of all, just top view of Lemonade itself, gross loss ratio ex cat, so no catastrophic events included. For Q1, they were at 59%. Before that, Q4 was 62%. Even before that, they had 63, 62, at a little bit higher Q3, but 59% or 59% in Q1. And Q2, I don't think we're going to see a lot of catastrophic events. There was not a lot that was very newsworthy, at least. So that's what I'm thinking on from one perspective there. You can say, well, I think 63% or something, I think it's maybe around 65% or potentially better than that. So that's why I'm plugging in 63%. Another way you can think about how could you think about what the gross loss ratio could be if I scroll down here. I have this breakdown of, different products, home and renters combined, and then I have home and renters sort of estimated split, pet, car, Europe, life. And if you plug in estimates for each product and, say you assume pet loss ratio is going to be 67%, Europe loss ratio is going to be 80%, and life is 70%. Is a tiny part of the business, but you say renter's insurance is going to be 35%, because I think renter's insurance, we don't really know exactly what it is, but if I had to guess, I'd probably think it's somewhere in the mid-30 range. And then home insurance, maybe can be very volatile depending on the amount of catastrophic events. But you might say, home's like maybe 85% in Q2 because there wasn't a lot of it. Now you plug in, although you take the average or the weighted average of all those loss ratios against to figure out your total loss rate, gross loss ratio, and you get 63%. So another perspective, you can sort of more detail each product line and still gets you to the similar gross loss ratio. It's kind of funny, even though we're talking about gross loss ratio of 63%, and like it's really amazing we're talking about 63%, because even a few years ago it was like 94%, 90% plus, and this was even at the time we talked about this on the channel lots, that it made sense the loss ratios were so high because we had really incredible record inflation during this time, and it takes time as an insurance company to essentially close the loop, the feedback loop that says insurance company says, yeah, our costs, our prices are not high enough to cover the costs that we're now bearing to cover these claims, because the cost of everything has gone up since we wrote the policies. It's gone up so significantly, and gone up since we had our pricing approved by regulators. So it's a slow feedback loop in insurance to filter all that back down to your bottom line. But that's not what we're seeing. We're seeing this really positive, very excellent loss ratio starting to emerge, where you have, Q4, we had 63%. Remember Q4, I believe it was that one. I was predicting, they're going to have a loss ratio of like something like 65% or better, or somewhere in that range, and it ended up with 63%, which I think was a bit of a shocker to people, because they were more in the 70s, 80s, 90s, we're used to having that. So I think this is going to be more the norm moving forward. As their pricing has become better and better. The other factor, though, it's going to affect your loss ratio is just that they're an insurance company and they get better at pricing, selecting the correct customers, and non-renewing or leaving the ones they don't want, or avoiding the ones they don't want. And that's going to, of course, the more they can sort of refine that underwriting, then that's going to improve your loss ratio. So you can think about loss ratio, another thought on it, you can think about it a few different ways. Like it can be something as simple as your pricing is not sufficient and you got to increase your pricing, and it takes time to do that. And that's really obvious. And then there's other factors like your your sort of underwriting skill level and your data science in selecting the right customers and avoiding the wrong ones can be better or worse. And so for Lemonade, that will keep improving over time. They're getting better. The rates are more in line with what they should be. And we should start to see some, I think, continued really excellent loss ratios. Annual dollar retention, I have at 85%. I have sales and marketing growth spend at around $38 million for Q2. And this will depend. This could be a little bit higher. I wouldn't be surprised this was higher and this was maybe a little lower. We'll have to see though. The way I'm calculating is I have a ratio of your growth spend to IFP that you acquire. And I have 2.7 for that. And all that means is that if you're, depending on the IFP I need to grow to, the way my model works right now is I put in a value for this ratio, this conversion ratio, and then that tells me how much they're going to be spending on growth spend in that quarter. And of course, the worse the ratio, like if this was 2, it's going to push your growth spend up significantly higher, and you'll be spending more, and that's more expenses, and then it's going to hurt your bottom line. I wouldn't be surprised if this was, again, I'm not trying to perfectly nail the numbers, more understand the sort of potential ranges of outcomes. Wouldn't be surprised actually if this was a little bit worse, that this was higher, and that kind of falls back in line with what they said they're going to spend, 40% more year over year, but we'll leave it as is right now. And this 2.7 figure, you can see previous quarters, 2.74, 2.42, 2.7, 3.54. And it's an really important thing to touch on, think about. If we look at a graph of the dollars spent in a quarter on growth spend versus the ratio that's achieved, you see a scatter plot of all the different quarters and their results. And a few things to note here, as you spend less on growth spend, your efficiency of this ratio is going to go, higher and higher. In fact, if you spent $0 on growth spend, you'd still acquire a bunch of customers because customers naturally cross-sell for no cost at all, and you'd have this essentially would go to infinity. You'd have infinite amount of IFP acquired for $0 in ad spend. Of course, that's not what they're going to do because you want to keep growing the business, and you can still spend dollars and be profitably spending those dollars. But that's essentially, that's how the graph would kind of look, follow a line like that, and then flatten out here at some point. Now, a few other things. Another thing to note is you can see this average sort of line over time, and as you spend more dollars on your growth in a given quarter, you tend to become a little bit less efficient, which makes sense. As you spend more and more and more dollars, each dollar, subsequent dollar becomes less efficient. But another thing to know within that is if you notice this average line below the line is basically all the quarters that were in the past, 2020, 2021, one from 2022, and then all the quarters above the line are basically in the more recent history. 2023s are over here, versus 2020 was not very efficient, was not very effective, and then 2024s are here, and then notably the last 3 quarters, Q3, 4, and 1. Of last 3 quarters were all above the line, even though they were high growth spend, they're still above the line. So the point, what you can sort of understand from that, or that tells us, is that hey, in the past they had less products in less places. And 2020 they might have only had some homeowners offered and like renters insurance, and that was it. And it was not very efficient because you just didn't have very many products and products that could cross-sell or people could bundle or sell into each other with or have available. But as you have more products, more places, you start to push this metric higher, even though you're spending more. And I should note too that just to note the IFP acquired, this is premium dollars that are coming in the door to Lemonade. There's also premium dollars that are churning or leaving as people cancel policies. But this is trying to calculate dollars that are coming in the door, and then we separately look at dollars that are leaving. And you can kind of weigh both of those more accurately than then the other way to look at it would just be net IFP change, which would then sort of factor two variables, lump them together, and it's not quite as crystal clear, I don't think. So, So here's the thing, though. As you think about pet and renters insurance, which are sort of two dominant products for Lemonade right now, those products are relatively small. Now they're something like the order of maybe $5 billion each in the U.S. Of course, pet is growing significantly in the U.S. and will continue to grow for, I think, many, many years or even decades. But they're relatively small products right now, maybe $5 billion a piece, versus car product, which Lemonade's really only just starting to dip their toes into now. Car product's something more on the order of like $300 billion in the U.S. So it's something like 60 times. It's like car is 60 pet markets, 60 times the size of the pet market. It's like Lemonade's in 1/60th of the total sort of market there with pet, and then they jump. Now they're starting to get into the full market with car, 1/60th of renters, something like that. So it's way bigger market. Of course, it's a very competitive market, but I think if Lemonade has a compelling product, which I think they do, if you haven't seen my car video, a car interview with Mikkel, the Lemonade lead of car, I encourage you to watch that. It gives a lot more insight into sort of how they're thinking about the car product and why that product should be a really excellent product over time. But the broader point I'm making is that I think this ratio, I'm putting in 2.7 for Q2, whatever it is. I think this ratio, even though they're going to keep spending, $50 million, $100 million eventually per quarter on marketing, I think this ratio is going to continue to stay strong because you're going to have more access to these much larger markets. And then other markets that they're already in, like pet, are growing rapidly in the U.S. just on their own. And then beyond that, Lemonade is going to expand more internationally and continue to expand and push internationally. So I think they'll be able to grow and spend more and more and more, and grow more and more dollars in a given quarter, still having strong unit economics. That's why I'm putting in 2.7 there and kind of have that out for the next number of years. So that's then factors you get into from that. You get your marketing. And how much you're spending on growth. But moving on. Synthetic agents, I still have 80% use of synthetic agents through the rest of the year. Other insurance expenses, I have growing 1% a quarter. Maybe we should have this growing faster, but it's a somewhat volatile line item. Tech development, I have it growing. I have it flat for the next couple years, and the reason I have it flat for the next couple of years is because if you look back over the last couple of years, it's been flat for the last couple of years. And in my mind, if they have this low-co engineering that Shai has been tweeting about, and they're becoming more efficient in doing more faster with the same resources they have, then why would they start spending more on their tech development and more on engineering costs? You'd think, if anything, you could probably do have less people on staff and less costs and less overhead and do more. So if anything, maybe this should be declining over the next 2 years. And then similar with general administrative, it seems like that's been a bit of up and down a bit, but it's been more or less flat over the last couple of years. So in my mind, it seems like, again, over at least the next few years, that should be relatively flat as they sort of grow into the capacity they have and as they become more efficient in the capacities they have. So all that together, I have at least right now, adjusted EBITDA loss of minus 28 million for the quarter. That's versus, guidance of minus 41. We have seen, adjusted EBITDA losses that significant of a beat. I don't know if maybe I'm looking too bullish at Q2, but that's what I have here. At least that's what plugged in for right now. Of course, if I thought, oh, they're going to be spending more on marketing, and this is the car ramp's not there yet, so this is going to be 2.4. Now your growth spend moves up, and your adjusted EBITDA is more like a minus $33 million loss. And maybe you could say, oh, maybe this 63% is too bullish, and let's make it called 65%. And you say, oh, maybe you're at minus $35 million loss. So now you're getting closer to the bottom edge of that range. Still probably going to beat even in that scenario. But it gives you sort of perspective on where things could go. So we talked about this metric, this conversion, or this marketing efficiency metric, which is something you're not going to see or understand or know if you're not looking at Lemonade really closely. But it will be something I'll be watching, because if for some reason this doesn't stay strong and they just keep spending more and more on marketing to try and grow, but then this slips and goes to 1.5, well, now you're suddenly spending way more on marketing to get the same amount of growth, and you're gonna have trouble growing the business profitably. It's gonna be a challenge. So depending on where that metric comes in, that's gonna be an important metric I will be watching. By the way, if you want to join, you want full access to this model, I do encourage you to join my Patreon. Get full access to that, along with exclusive other content, videos. I will be coming out with merch here at some point, and be giving a discount to Patreon members for that. But I have capped different tiers. The next one is $5 a month to join, and we're at 108 people out of 200 spots. So eventually that is going to fill up. And yeah, every quarter it's nice because I update the model for you guys and continue to make it better. So another metric though I want to talk about is the Multiline metric. We're talking about Patreon. I have a Patreon Discord, and some of us were talking about the Multiline metric and how we could watch that, where that might go over time. And I had a really good question and got a really good answer, I should say, from Daniel in Q1 of 2025. The say questions there. I asked about, where might Multiline, in other words, the percentage of customers that have more than one products, where might that go over time? And he roughly said it's around 5% now, maybe some states and little pockets where they have all products available. It's closer to 10% of customers. So you get more Multiline customers there. But he says, we expect that will become break even somewhere in the probably the high single digits range, and then profitable in the high single digits, and then in the following years go into the teens and ultimately the 20s. So it's a be an important metric to watch, and I have been tracking that. If we zoom down in my model here, I have a full breakdown of, as I showed earlier, of different products, all products together, and then home and renters combined, and then renters only, home only, pet, car, Europe, life. And within each, say one of those products, say pet, for example, management gives us your pet in-force premiums along with your pet premium per customer, and from that you can figure out, hey, there's something like 441,000 pet customers. And then if you add up all the pet customers, or maybe you could call them pet policies, you may say, well, we had 2.7 million pet policies in Q1 versus 2.545 million total customers. So you can get a policies per customer of maybe 1.07. And it's also not a perfect comparison to what Daniel said, because maybe some customers have 2 policies, but some Multiline customers have maybe 3 or 4 policies. So it's not exactly comparable, but it's probably roughly comparable. And you can see that it has been improving sort of slowly, gradually, and was more like 1.046, and now we're at 1.07. And I have this sort of gradually improving over the next few years as CAR rolls out. But this will be really important. I'll be tracking and watching this here on the channel and within my model here. Another thing to think about with Q2 is they should update the guidance for the remainder of the year. And you can see we had guidance of, say, for the rest of the year of $135 million adjusted EBITDA loss. But if we look at where I'm modeling, at least right now, adjusted EBITDA loss for 2025 of about $113 million versus $135 million. And that's partly, just because I think I'm bullish and I think they're going to be beating their metrics, but also because I don't think their guidance originally had the reinsurance change factored in. And so if you do factor in your reinsurance change, where right here, if, say, instead of reinsurance tapering down, it stayed at 55% across the year, now you're at adjusted EBITDA loss of not 113, but 121. So still a beat, but not as significant a beat as, say, as I am now forecasting. So we should see, I would think we're going to see some improvement in your adjusted EBITDA loss and also your revenue line item for the full year 2025, which could be a bit of a positive catalyst for the stock this quarter. If you think about, revenue, they have a high end $663 million, and I have for the year, I have 683 plus, I got to add in, my investment income is 36 plus, 720 million I'm at versus 663, because majorly revenue is going to move more significantly than adjusted EBITDA because of the way reinsurance is set up and affects your revenue. And if I flip this, and I don't think that revenue, or I don't think their guidance for the year was factoring in that they would probably reduce the reinsurance. And I think it was just keeping the 55%, because, for example, if I flip these back to 55% and I just look at revenue, I go revenue here, and then I'm going to add in, I don't have investment income included in that, but if I add that in and go to some of that, I have 664 million of revenue versus, slight beat on their guidance of 663 million. So that's with the 55% across the board. And then if you you start to taper down the reinsurance, that's going to really bump up your revenue. So that could be a really positive catalyst and start to change the understanding of the finances of Lemonade, seeing that guidance change here in Q2. And that kind of leads me into sort of a broader point about the quarter as a whole. I'm really excited and bullish about the next few years for Lemonade as a whole. It's just a very exciting time for the company. It's as we march towards profitability, I think there's going to be sort of aha moments for the market where they start to realize, this ship is in fact turning around, and we can't just look at the basic like, their operating expenses keep increasing and their losses they just lose a lot of money. At the end, they'll have to sort of realize actually their losses are starting to significantly drop because the investments they made previously are starting to pay off. Previously being last year and heavily already this year, those are going to start to become obvious as they pay themselves back, and they become, adjusted EBITDA profitable next year and then net profitable the year after. Because you think about it, like right now, the market says, they're guiding for $135 million adjusted EBITDA loss. But then you go, actually the revenue switch might happen and there might be a $113 million adjusted EBITDA loss. And then next year might come and they get guidance for 2026, and they might say, actually, we're going to do minus $17 million. And people say, wait a second, minus, you're supposed to be losing like 140 million a year, and now you're talking about losing adjusted EBITDA wise only 17 million. Like, wait a second. And then they'll say, oh yeah, 2027, we're going to be plus 50 million or plus 48 million. And then they're going to say, yeah, in 2027, we're plus, $48 million adjusted EBITDA profitable. And our net income will be, break even. Like, that's going to, I think, really sort of slap people in the face as they get the guidance for 2026. And then as they get the guidance for 2027, those next 2 Februaries where you get the Q4 results and the guidance for the next year are going to be really, really significant inflection points. But it also could happen really any quarter or partially sort of happen, start to turn, have this inflection point where the market really gets what's finally coming and realizes, hey, lemonade's probably worth more between, $90 to $200 per share right now, something like that. One other thing I did want to touch on in this video was the Texas flood. Some people might be wondering, hey, is that going to affect the results or the guidance? Well, for one thing, the Texas flood will not affect Q2 because it happened in Q3. It happened in July, which is Q3. So it's not going to be affecting the Q2 numbers. Will it affect your guidance for Q3? It's hard to say. I haven't done a ton of analysis on it, but Josh on Twitter here, who's an insurance actuary, tons of insurance background experience, he did this analysis to say, hey, if we have 1% of the car market and there was, 8,000 cars that were destroyed at $25,000 a piece per car, that means by the floods, that might mean losses of $2 million. So it's really a nothing burger. I think this will be a nothing burger in Q3. I don't think it's going to be a major effect on them, whether they even mention it in the call or somebody asks and one of the questions could happen. But I don't see that as a really important factor here for them. So yeah, let me know down in the comments what you think of Q2 and what you're expecting. Would love to hear your feedback. If you want this model and you want to dive even deeper, please join my Patreon, support the channel. I'm trying to get to 200 people or members this year. Not sure if that's possible, if we'll make it, but that is would be really cool if we were to get there. We're at 141 right now. So thank you to everyone who's part of that and people who will be joining. And thanks so much for watching. And remember, it's in the bag.